Hello world and welcome to the Figure It Out Guy podcast, episode 3, How to Start Investing. Today's episode is basically being created because after I had the first podcast that was how to make the most of quarantine, I had a lot of people asking me about investing, and I kind of mentioned it briefly in that podcast that I'd gotten into it and some things to check out. But I was asked multiple times to dive in a bit deeper, particularly on high yield savings accounts, stocks, and different retirement accounts, things like that. So your wish is my command. And in this episode, I am going to do a very deep dive into high yield savings accounts, not only what they are, how they can benefit you, but also how you can go about getting started and some places to look. As well as stocks and all the different investing options there, and retirement accounts. So we'll take a look at all of the different retirement accounts. Well, not all of them, but the ones that are by far the most popular, so that you can kind of get an idea of some things that you could take advantage of. These might be things that your companies offer that you didn't know were available to you, and also just kind of generally how to maximize those things. Now, gigantic disclaimer, for legal purposes, of course, is I am not a professional. I am not a tax advisor. I am not a retirement or financial advisor. I am a dummy, and I in no way am a professional, and everything that I talk about in this podcast is strictly my opinion and that of the internets. So please make sure you always consult a professional before you start giving your money up for anything or sign up for anything. Always know what you're getting yourself into. That is definitely something I will repeat consistently throughout this podcast. But just in case, and just to make sure the lawyers don't get upset with me, I am not a professional, and everything expressed in this podcast and recording is specifically my opinion. So with that being said, again, thank you so much for everyone, by the way, who reached out after the first podcast and asked me to dive a little bit deeper into investing. I'm glad you guys took interest to that. I'm glad some of that information was valuable to you and helpful. So that's the main goal of this episode, is to give you some useful information to help get you started. I particularly looked at things that don't involve an insane amount of money to get started. A lot of them don't require, well, technically you can start them without any money, but obviously you will not make any money without putting any money into it. So with that being said, I hope that you guys really enjoyed this podcast. I hope that you enjoy the beautiful PowerPoint presentation that I put together just for you. And as always, if you really like what you see, if you are enjoying the content, please let me know, leave a comment, let me know things that you're trying, or maybe some things that I missed that I should check out, or anything like that. And definitely make sure to like this, because it helps out quite a bit, especially for the YouTube and iTunes algorithms there. So please make sure to like the podcast. And also don't forget to subscribe, so then that way I can grow. I want to be in triple digits, guys. It's possible. We can do it. But yeah, probably not if I always make super vanilla and arguably somewhat boring podcasts that are about investing. But I think a lot of the folks that listen are probably about the right age to where they're like, hey, how should I set up for success in future finances and have financial freedom? Well, this is not a get-rich-quick scheme. These are just some basic ideas to help get you started and things that you can take a look at without breaking the bank, so to speak. So without further ado, enjoy the podcast. Thanks so much for tuning in, and let's go ahead and get it started. Oh yeah, check out that spiffy intro to investing PowerPoint, son. Get at it. Sorry if you're just listening on iTunes or SoundCloud, you can't see it, but damn, it's beautiful. I will be reading verbatim what I have in here, so you should still be able to get plenty of information if you're just listening and not actually watching this video on YouTube. Also, I will have the video, or the link to the video that spawned this one, in the link below, so make sure to go check that out if you haven't already. All right, so Intro to Investing by the Figure It Out Guy. I'm going to be testing out voices as we go through this, but what is investing? What can I do? what the hell are you talking about right now? And why is this important to me? So if you want to get set up for the future, and when things like the coronavirus hit or an economic collapse or anything like that starts to happen, you want to be set up and you want to know that you have your emergency funds going and that you have some sort of fallback plan. So in my opinion, you can never be too prepared for things. So I'm learning as I go. This is not something, it's not like I have 10 years of experience in investing and knowing exactly how you should do that. And actually that leads me into my next thing. So quick disclaimer. Oh, I'm sliding the wrong way. I am a dummy. That being said, I am not a professional. Everything that I talk about in this video and in this podcast and in this recording is all strictly my opinions, things that I've either tried or that I've learned about, and should not be taken as financial advice. You should always contact a professional should you have anything that you want to get set up regarding your finances. It's always good to contact a professional. So I am a dummy. Please, these are just some things that I found throughout the way that may help you along, but they are my opinions. Again, disclaimer, I am not a professional and these are strictly my opinions. Okay. Now that we got through that, first thing I wanted to talk about, which had the most interest by far, was a high yield savings account. What is a high yield savings account? So a high yield savings account is a type of savings account that typically pays 20 to 25 times the national average of a standard savings account. So if you, for instance, I have a Chase account, and with the Chase account, if you look at a savings account, my current interest rate, I believe, is like 0.1% is what I'm accruing in interest in my savings account, which is nothing. So that is pretty terrible, right? So that means as inflation goes up, I'm actually going to end up losing the value of my money. You can go do a deep dive down inflation if you want later on. But basically, most people know that, for instance, money in 1970 has a different value versus money today. Hence why they'll say things like $1 million in 1910 is now worth $100 million. Those sorts of things. It's inflation. So that being said, when your money's just sitting somewhere and not accruing any interest, the value of that money is actually going down. Now, I know that comparing the 1910 $1 million example to being worth $100 million now is not exactly helping clear that up. But please, if you want to do a deep dive in inflation, you're more than welcome to. But you can just kind of take my word for it that there's a thing called inflation and that your value of your money will actually go down if you are not accruing any interest on it. So that being said, let me go ahead and slide. I'm going to see if I can slide out of the way here. Okay, cool. So if I just kind of show half my face for the remainder of this video, you guys will actually be able to read the content. Cool. So traditionally, people have held a savings account at the same bank where they hold their checking account. Very straightforward. You usually have one and the same, where you have a checking and savings account at one bank and you can transfer between them, those sorts of things. But with internet-only banks, as traditional banks that have opened their doors to customers across the country are using online account opening, the competition on savings rates has skyrocketed, and that's good news for us. What that means is there's a new category called high-yield savings accounts. So, some things to consider when it comes to high-yield savings account. The interest rates are typically insanely higher than what you're seeing right now, and you can compare this at any point that you would like. Just look at your savings account at whatever bank or institution you're using, and they'll have an interest rate there, and you can compare that versus what high-yield savings accounts are offering. So typically 20 to 25 times higher than traditional savings accounts. This means that, for instance, in certain accounts that are high-yield savings accounts, if you were to put, let's say you were rich, and this is just one example of how the rich can continually get richer and make their money work for them, is let's say they put $100,000 into a high yield savings account. Now, if that put out, let's say 1.7% annual percentage yield, around there, they would essentially be making $1,700 a year for having that $100,000 sit there. Now, you can imagine that once you get up to the point of having, that kind of money, you can literally just leave your money in accounts that will make you thousands of dollars a year without you doing anything. So that's why a lot of times they say make your money work for you. Well, it's easy to say when you have a shit ton of money and you can make it work for you. But The same idea applies to those of us who are the peasants and are not millionaires. So you put, $100 into one of these accounts. Let's say it pays 1.5% annual percentage yield. You will get $1.50 back every year. So it doesn't sound like a lot, right? But you got to remember compounding. So the more you add to that, the more that number grows. And also, this is you putting money into an account and doing nothing with it. So they are great for emergency funds. Funds you're not gonna touch a lot, and you're gonna leave alone for a while. Or if you want to have, if you have a short-term goal that over the next 3 to 5 years or something, you want to have X amount of dollars, and you want to be able to set it aside and not touch it. High yield savings accounts are great for that because they're just going to accrue interest without you having to do anything, and you can continually add to them. A few other things here are a lot of your banks, like where you already bank, may have high yield savings accounts, but usually, generally speaking, the best rates to get the most bang for your buck, so to speak, are going to be online only banks, like which I will show some examples here shortly. Electronic transfers are easy to set up between a high yield savings account and your checking account, even if you hold them at different banks. I can verify that that is true because I've done it myself. I have bank accounts with Chase, and then you have bank accounts with a place like Ally, which is an online only bank who does offer high yield savings accounts. Those you can transfer back and forth between without any issues. So kind of one of the main things to think about as you're going through this is to consider different account options. So different high yield savings accounts will have different factors such as initial deposit requirements, interest rates, minimum balance requirements, and any possible account fees. So you want to be very careful when you're shopping around. You want to make sure you know exactly what you're signing up for, as some of them are completely free, require no deposit down to start the account. Some of them require $10,000 to start getting the best annual percentage yield. And without that, you get virtually nothing. So you want to make sure to really check the details on there, especially when it comes to account fees, if they have maintenance fees, those sorts of things. You really want to make sure you do your research on that. Now let's take a look at some examples. So I obviously could not talk about high yield savings accounts without putting some examples in here for everyone to see. So the one that I am actually considering opening as we speak is HSBC Direct. So HSBC is a gigantic national bank, international bank, excuse me. I believe they are based in, I want to say the UK, but I could be wrong. But they started a thing called HSBC Direct, which currently is offering 1.6% annual percentage yield, meaning annual percentage yield, by the way, is just what percentage of the money you put in there will you get back each year. Hence annual percentage yield. So right now they're offering 1.6%, meaning that after a year, you're going to get 1.6% of what you have in there. This does go obviously, month to month. It's dependent on how much you have in there. And again, check the details of everything before you sign up for something to make sure you know what you're signing up for. This one requires a $1 minimum opening deposit. So one thing I want to get out of the way right now is there are accounts that you can open that may or may not have higher annual percentage yields, but I tried to only include ones that require either zero minimum to start or a $1 minimum or things like that, and don't have hefty fees. So that's what I tried to avoid, where anything that was like you have to have a $10,000 minimum to get their annual percentage yield or those sorts of things. So these are, again, do research, check it all out, but the ones that I've listed here do not require insane amounts of money to get started, and they don't have hefty fees. So the HSBC Direct Savings Account only requires $1 to open, and there's no monthly maintenance fee. Your initial deposit needs to be new money, which are deposits and investments not previously held by any member of the HSBC group in the US. So basically, you have to start a new account with new money. There is a $10 monthly service fee if you have a checking and savings account linked and don't meet the requirements to have the fee waived. What that means is this is something to really pay attention to. A lot of these accounts, if you want to have checking and savings in the same spot with this high interest high yield savings account, a lot of them do require either monthly fees or a minimum balance to avoid monthly fees for having both. So make sure to double and triple check that whenever you're signing up. Next, we have Citibank, which is offering 1.55% annual percentage yield with a $0 minimum opening deposit. This is one that is not available in some of the larger states, such as California and New York. That list may be a little bit longer, but those were the two that I found. There is a $4.50 monthly service fee if your savings account isn't linked to a Citi checking account. You can avoid this fee by keeping an average monthly balance of at least $500 in your savings account if it is not linked to a Citi checking account. So in this case, it is probably a good thing to just go ahead and set up the checking account, but again, completely up to you. Talk with a professional. And finally, there is a $10 monthly service fee if you have a checking and savings account linked and don't meet the minimum requirements to have the fee waived. So make sure that you comb through all these and you know exactly what the fees are, what the minimums are to avoid those fees, so on and so forth. Then we have Ally Bank. So this one has been around for a while. I believe currently this still holds. Now with the coronavirus, again, you're going to want to do more research because this changes almost weekly with some banks pulling back on paying out high interest yields, some things like that. So always make sure to know the up-to-date information. But Ally Bank is offering a 1.5% annual percentage yield and requires $0 to have that opening deposit to get things started. Ally Bank started in 2004 and is headquartered in Sandy, Utah. In 2009, GMAC Bank was transformed into Ally Bank. Ally Bank exceeded 1 million Ally Bank customer accounts by 2012 and currently has 1.5 million customers. So it is an online-only bank, and it is one that is FDIC insured, I believe. You can double check that, and has over 1 million customers. So one thing I noticed is some of these banks, when it comes to online banks, you want to do a lot of research because some of them seem a little bit sketch, like they just started this year or a few months ago, or they just started last year. So you always want to make sure that these things are insured, backed up, and that if something were to happen, you're safe and you don't have to worry about your money. That's just kind of, most of them are completely legitimate, but you always want to, again, do full thorough research to know what you're getting into. Then we have the Ally Bank also offers a checking account, a money market account, term CDs, a no penalty CD, and 2 terms of a raise your rate CD. So CDs are certificate of deposit accounts. I'm going to go into those actually right after this. I'm not going to spend a lot of time on them, but they are also an option for investing. However, they get a little bit tricky in terms of if you're trying to get your money back out of that. Usually the setup is you just have to give them X amount of dollars for X amount of time, and then you get paid at the end of that time. But you can't touch the money usually in between that time. But we'll dive a little bit further into that shortly. So that's kind of the wrap up of Ally Bank, 1.5% annual percentage yield and $0 to get started. And they do offer checking accounts as well. Then we have Marcus by Goldman Sachs. So this is kind of a branch of Goldman Sachs that is offering 1.55% annual percentage yield, again with $0 minimum opening deposit. Marcus by Goldman Sachs is a brand of Goldman Sachs USA, or Goldman Sachs Bank USA. Marcus offers a variety of CDs, 3 no penalty CD terms, and a competitive yield on its savings accounts. Marcus by Goldman Sachs now has an app available on iOS and one coming to Google Play this spring, according to their website. So this is a familiar name. Mostly everybody's familiar with Goldman Sachs. 2008 was not exactly the best year for them, but Goldman Sachs does have Marcus, which is kind of a newer thing that they're doing where they're offering these high yield savings accounts, and they're trying to get more tech with it, I guess. So they're developing an app and something in the Google Play Store. So definitely something to keep an eye on there. So that kind of concludes high yield savings accounts. This was the one that I probably had the most interest in, was high yield savings accounts, what those are, where to find them, and those sorts of things. So again, those are just some examples that I had listed, but hopefully now you kind of have an idea of what those are and kind of what the key takeaways for a high yield savings account is, and why you should go ahead and probably set one up, just because, again, inflation, at the very least, you're going to, hopefully outbeat inflation. So definitely something to consider. Most of them do not have super stiff requirements to get started, so you can at least start investing now and get yourself set up for the future. The next on the list kind of goes hand in hand a little bit with high yield savings accounts. It's a little bit different of a setup, but this one is old, tried and true certificate of deposit. It's been around a long time. And basically a certificate of deposit, or CD is what it's commonly known as, is a type of federally insured savings account that has a fixed interest rate and a fixed date of withdrawal known as maturity date. CDs also typically don't have monthly fees. Share certificates, which are the credit union version of a CD, are also low risk as they are insured up to the same amount through the National Credit Union Administration. Savings accounts let you deposit and withdraw funds relatively freely, but with a CD, you typically agree to leave your money in a bank for a set amount of time called the term length, during which you cannot access the funds without paying a penalty. That is a very important one to keep in mind when it comes to CDs. Think of it kind of as a loan. You're going to put X amount of dollars into a bank account, that's a CD, and you already agree to, usually it's a fixed rate, and you agree to, for 5 years, you're going to leave this money in there and you're not going to touch it, and it's going to accrue X amount of interest over that time, and then they pay you out at the end and you get your money back. So very similar to loaning the bank money. A lot of times if you do need to get a hold of that money again, you will pay a penalty to do any withdrawals. So that's something to keep in mind when it comes to certificate of deposits or CDs, is that money you're basically going to loan out for X amount of time, and then you get it back with interest at the end. Term lengths can be as short as a few days or as long as a decade, but standard range of options is between 3 months and 5 years. So something to keep in mind. Usually, I believe the way it goes is the longer term, generally speaking, the more you'll get out of it. I think a lot of these can be like in the 2%, 2.2% range of a yield. So basically you would get 2.2%, building over the term of that length. And then you would get that at the very end when the term is expired. So again, the best way to think of CDs is a loan to a bank, and then you get X amount back with interest. So you get your money back plus interest at the end of the term length. Now we're going to dive a little bit more into retirement accounts. This was another thing that was brought up quite a bit on the feedback from the first video. I had mentioned high yield savings accounts, and everybody was very interested in that because that one, generally speaking, is pretty straightforward. I mean, if you have a savings account, as long as you do your research on it, you should, in theory, be able to set up a high yield savings account and at least get that money to work for you, a little bit more so than the very, very low amount of interest I'm sure you're accruing right now on your savings account. So that one's kind of easy and straightforward. Definitely look into high yield savings accounts. Next, I'm going to go into the retirement accounts. Again, this was brought up quite a bit. What type of retirement accounts are there? Specifically, I had a lot of questions about Roth IRA, those sorts of things. So I'm going to kind of go through the top and most common retirement accounts. A lot of these you'll be familiar with, like this first one I'm going to go over is 401k. So this is a retirement account that usually is offered through your employer. However, there is a thing called the 401k solo. If you're independently employed and or self-employed and don't have any workers, you can look into a 401k solo. But we'll go back. The general masses are familiar with the 401k, so I'll kind of go through these a little bit quicker. But basically, a 401k account is offered through employers, so you obviously have to check with your employer and workplace to see if this is available to you. 401ks, usually if you have a really solid setup with retirement at your workplace, they'll usually match a certain percentage of what you put into 401k, which is fantastic. I highly recommend that if you do have that option available to you and your employer is willing to match what you put in up to a certain percent, you put in as much as you can. Basically max out that percentage to make sure you're getting the most bang for your buck. In 2020, the IRS allows you to contribute up to $19,500 to a 401k if you're under 50 years old. If you are age 50 or older, you can put up to $26,000 in the 401k account. Your employer may match a certain portion of your contributions. The amount contributed to a 401k is deducted from your taxable income. you'll need to start taking withdrawals from the account known as a required minimum distributions starting at age 70 and a half. So something to keep in mind here, that third point that I made, the amount contributed to a 401k is deducted from your taxable income. That's something to keep in mind. That is one of the primary distinctions between a Roth IRA and a 401k. The amount contributed to the 401k is deducted from your taxable income. So something to keep in mind is that when you get further down the road, you're going to obviously, this is tax-free up front, basically, is what happens. And you end up paying taxes in the end unless you hit certain requirements. But when funds are withdrawn, they're subject to taxes. So like I was just saying, something to keep in mind is that when you take the money out, that's when the taxes hit you, but it is not taxed going in. So you may also face penalties if you take money out of the account before the age of 59 and a half. That is a big one to keep in mind. So with the 401k, the best possible scenario is you have employer matching and you do not touch the money until you are 59 and a half years old. If you take out money before that, the distribution penalties are usually pretty steep. Like I think they range between 15 and 25%, depending on the current situation, how much you're taking out and those sorts of things. But the general rule of thumb is if you can, don't touch the 401k money. Now that can be hard for certain things like right now. I do believe the government with the CARES Act did include something about being able to take distributions from the 401k without penalty. Definitely research that because I'm kind of just talking out of my ass there, but I'm almost certain I heard something about that. But generally speaking, you will get penalized pretty heavily if you take out before 59 and a half because you get hit with the taxes and penalties on top of that. So you lose a big chunk of that money if you take it out before then. Next, we have the IRA or individual retirement account, a general IRA. So an individual retirement account is only available to those with earned income. You have to have income coming in. If you earn $2,000, you'll be able to put up to $2,000 in the account. The contribution limit for an IRA is $6,000 in 2020 or $7,000 if you are 50 years or older. Like a 401k, you'll receive a tax deduction for the money you put into the IRA. When you withdraw the funds, they will be considered taxable income. You'll need to start taking distributions from the account after you turn 70 and a half years old. That is when it will require you to start taking distributions from an IRA. Next, we have the one that a lot of people asked about, which is one that I have currently open through Vanguard. It is a Roth IRA. So like an IRA, you need earned income to be eligible for a Roth IRA, and the amount contributed cannot be more than the amount you earn. So essentially, they have limits on IRAs of what you can contribute each year, and it can never be more than you earn in a year. That being said, most of you earn a lot more than what their limits are, but definitely something to keep in mind. So you can set aside up to $6,000 in 2020 or $7,000 if you are age 50 or older. Unlike an IRA, you'll pay taxes on the amount of money you contribute to a Roth IRA. However, the money grows tax-free in the account and no income tax will be due on the Roth IRA withdrawals in retirement. So basically, this is front-loaded. You're going to pay the taxes going in, but then as those capital gains go in throughout the growth of this account, you will not pay extra basically when you take the money out. So it's front-loaded, you pay up front, whereas a 401k, you pay when you take it out. Roth IRAs, you pay up front. So these are great as kind of individual accounts, hence individual retirement account. But let's say you have a 401k through work, they don't match, or even if they do, you still have some extra left over and you want to have another retirement account that is going to earn you money. A Roth IRA is a great way to go for that. You can contribute to the account for as long as you continue to earn income, including after age 70 and a half. So that also differs a bit. You're not required to take everything out at 70 and a half. You can keep going after the age 70 and a half. A Roth IRA does not require that you take distributions in retirement. So again, that's kind of a difference between the IRA and the 401k. So you don't have to take distributions from a Roth IRA. You can just leave it there. depending on your setup, you may or may not want to do that. But that's kind of a deeper dive into a Roth IRA. The big things to take away here are that it is front loaded, so you're going to pay taxes going in, not coming out, and that you're not required to take distributions in retirement. Obviously you can, but a Roth IRA is great for a lot of different things. You have flexibility when it comes to setting it up. So for instance, my Roth IRA has exchange traded funds in it, which is something I'm going to dive into here shortly. But basically you have a little bit more flexibility with a Roth IRA. It's great for kind of a second retirement account, or if you are self-employed or anything like that. A Roth IRA is a great way to go. You basically pay the money in and then let it sit. But if you do, take some out, you're not going to get hit with steep taxes and all that stuff at the end. So again, do your research on this. Several institutions out there offer these, but do your research and check into it. Roth IRA is great. I cannot stress it enough. It's awesome if you can set it up to get started now. Then there's one that a lot of people that I know personally have this available to them and they do not take advantage of it. So in today's environment, a lot of people are taking high deductible insurance plans from their employer, right? So your employer's offering a high deductible medical insurance plan, and maybe that's the cheapest one. Generally speaking, it is, and a lot of people opt in because of that. Or maybe you don't get sick a lot, and so you're like, I'm going to take the high deductible as kind of a just in case. So with high deductible savings accounts, there usually should always be a health savings account that is attached to that as an option. So this is something to definitely look into, especially if you have a high deductible medical insurance account. Health insurance, sorry, I keep saying medical, but health insurance, one and the same. You definitely want to look in and see if this is available to you. So a health savings account can be used to build funds to help cover health costs in retirement. To be eligible for an HSA, you need to have a high deductible health insurance plan. You can contribute up to $3,550 to an HSA in 2020 as an individual, or as much as $7,100 if you have family coverage. There is an additional $1,000 contribution allowed if you are 55 years or older. The amount set aside in an HSA is tax deductible. The funds grow at a tax-free the funds grow tax-free and can be withdrawn tax-free if they are used to pay for qualifying medical expenses. So a health savings account, basically you can put money into this to save up for, oftentimes a lot of people will use this for like if they need LASIK down the road or some sort of surgery or something like that. You can, if it qualifies as a medical expense, you can have this account ready to go. So this kind of offsets the fact that you have a high deductible plan, basically meaning that if you have a high deductible plan, you're probably going to pay, let's say $5,000 out of pocket if something goes wrong and you need surgery. Usually it's somewhere around there, $3,000 to $5,000, maybe more, maybe less, but typically it's around that range. So the high savings account will allow you to save money on the side that is tax-free, and oftentimes employers will match the money you put in there up to a certain percentage. So that is something to also check with HR or whoever's in charge of that. Check with them and get the details on this. But oftentimes you can get that money matched. So if something did go wrong, you have all this money set aside in an HSA that will essentially grow tax-free for you without you having to do anything. So it's kind of a safety net there, which is fantastic to have, especially if you have a high deductible health plan. One thing to keep in mind is like flexible spending accounts like I have, they are most of the time they're use it or lose it year over year. So you have to use the money that's in there. Otherwise you lose it. HSAs continue on forever. So an HSA will just continue going and it will continue growing. So it's not a year to year thing. This is something you can hold on to. Even if you leave that company, you can oftentimes hold on to an HSA. And a lot of times if you go with a new company that maybe has a different provider, you can work things out to roll those in, whatever you want to do. But you will be able to continue year over year holding on to this. So that's a big thing to keep in mind. Next, we're going to dump. We're going to dump right in here, boys and girls and everybody else. Next, we're going to jump into stocks. So this is something that also had a lot of interest. People were wondering, what am I doing with stocks? I'm not a professional stockbroker. So again, everything I'm putting here is general information and my opinions combined. So Generally speaking, stocks are just a portion of a company. When you buy a stock, you're buying a small percentage of that company, usually. The easiest way, if you think of every movie ever, is you buy low and sell high for stocks, and that's how you make money. But yes, generally speaking, the best way to make money with stocks is that you buy into the stocks, and then that stock price goes up over time because the company becomes more valuable or whatever it may be. And that's the number one way to make money off of them. You sell them, you make a profit. But then the next way that a lot of people look over is dividends. So a lot of companies will pay dividends to their stockholders, meaning that usually it's quarterly. You get quarterly dividends or annual dividends where a company will literally pay you X amount for having stock in their company. And you get paid, usually it's per share, by a small percentage, you get paid per share, and you get that every quarter. So as the company grows, if it pays out dividends, this is fantastic because you're going to get paid quarterly. And as that company grows, if you ever wanted to sell, you're going to make a profit on that sale. So getting stocks in companies that pay dividends is always a great idea. It's just something to look into because you're going to get basically paid to have that stock and then paid when you sell that stock, assuming everything goes up in value. Oh, do you agree, Oliver? Yeah, no, he's super stoked about dividend stocks. So something to keep in mind, dividend stocks get my dog very excited. But yeah, generally speaking, you can make money off dividends, getting regular distributions that go out to the investors, and you can make money when you, in theory, that stock goes up in value if you picked well, and then you can sell that stock for a profit. One thing to keep in mind is that stocks are a little bit riskier, so companies can lose value or go out of business, which is why you'll see things like the stock market crashed and everybody's stocks went to shit and it's all failing and everything is blowing up and there's fires everywhere. The stock market is riskier than all of the options that we've discussed so far. Just for that reason, economies can crash and companies can go down in value, which means your stock price is going to go down, which means your investment in that stock is going to go down and the value of it's going to go down, which means you're losing money at that point. But one of the most valuable things I've ever heard is you can't lose money on a stock until you sell the stock. So that being said, you got to know a lot of information about stocks. I got opened up to this world like in depth within about the last year. I've been going really hard in the stock paint, so to speak, just trying to learn about it. And it is so complex and so much luck is involved that it's very volatile and definitely something that if you're going to do individual stocks and do it on your own, you really, really want to do your research and know what you're doing. Because even if you are 100%, I know everything that's going on, things like COVID-19 will hit and you will have not seen that coming. And so hopefully you are diversified enough to have a portfolio that will withstand this. So that's why stocks and companies like Apple and Amazon and who am I thinking of? Google or whoever, these gigantic publicly traded companies. The reason that they're so expensive is because those companies are worth so much. But also, if you look at things like if you invest in Apple stock, the chances of that stock, like even if COVID-19 hits, sales go down, the chances of that company going out of business and not bouncing back from these sorts of things is much lower than if you went and bought like a penny stock of a company or a biomedical stock of a brand new company that isn't, hasn't been around a long time, maybe doesn't have a lot of capital, whatever it may be. So you really, really, really want to do your research when it comes to stocks, and they are extremely complex when you do individual stocks. Next, we have bonds. So a bond is a little bit less risky. Basically, it's a loan you make to a company or the government. When you purchase a bond, you're allowing the bond issuer to borrow your money and pay you back with interest. So this is typically government or company. It's kind of like CDs and the fact that you're essentially going to put this money out for X amount of time and then get paid on interest. But these are typically through a company or a governmental agency, which is why you have like government bonds and those sorts of things. Bonds are generally considered safer than stocks, but they also offer lower returns. So as with most things in the world, more risk equals more reward, but also more risk equals more risk. Basically, you can really screw things up if things go sideways. So Again, always talk to a professional when it comes to any of the things we're talking about. Make sure you know what you're doing before you start throwing money in places, and just have a thorough understanding of what you're getting yourself into. But bonds are generally less risky than stocks. The primary risk, as with any loan, is that the issuer could default. U.S. government bonds are backed by the full faith and credit of the United States, which effectively eliminates that risk. Still, technically speaking, some people would say that there is still a risk. Some, unforeseen circumstances could happen, and with total anarchy, whatever. At that point, I don't imagine money would matter much anymore. But state and city government bonds are generally considered the next safest option, followed by corporate bonds. The safer the bond, the lower the interest rate. So again, more risk, more reward. Less risk, less reward, generally speaking. But everything I'm mentioning here are ways that you can make money and invest for your future. So keep that in mind. Now, a lot of people, when they see like, oh, I'm only getting 1% or 2% or 3% or 10% back, they don't see that as very much. But you got to remember, a lot of this is for you not really having to do anything. Individual stocks is a little bit different. If you're becoming your own stockbroker or whatever, and you want to do day trading or swing trading or any of that kind of stuff where you're individually picking stocks, if you do that well, it's typically a full-time job if you're constantly doing it. But long-term investing is probably the best and easiest way to go, where you buy something and hold on to it for a long time. But that's for another video or another podcast. So how do investors make money on bonds? Bonds are a fixed income investment because investors expect regular income payments. Interest is generally paid to investors in regular installments, typically once or twice a year, and the total principal is paid off at the bond's maturity date. So I know I said it's somewhat kind of similar to CDs earlier. CDs, you typically only get paid at the end when everything has matured and your term is over. Bonds will pay out usually once or twice a year, and then the total principal is paid back at the end of the entire maturity date. So again, something to keep in mind. But bonds are a great option if you want something that's less risky than stocks. Again, you're basically investing. You can invest in things like the U.S. government and buy government bonds, where you're basically saying, here you go, government, take this money as a loan, pay me back X amount when this is all done, and that's it. Now, you're obviously not going to get huge returns, and a lot of these things, stocks, bonds, all those sorts of things, there's ways around where you can make money faster on them. But again, the general rule of thumb is the more risk you take, the more reward you'll get, but it is more risk. So the risk of you losing everything is much higher when you start doing things like day trading as opposed to buying into bonds. So something to keep in consideration. A lot of these are, you're going to lend out your money, or you're going to put your money into an account, and then it's just going to grow over time, or you're going to get paid at the end. So those are things, that's why it's called investing, because you're investing in something to try and get money back out of that investment. So it's not something that generally happens overnight. So you're not generally going to start with $100 and then have $1,000 the next day. That's not how this works at all. If you are doing that, you're probably a drug dealer. So next, this is something that is very popular, mutual funds. This is something that a lot of things are set up with employers and 401ks and things like that. They'll buy into mutual funds. Basically, mutual funds allow investors to purchase a large number of investments in a single transaction. These funds pool money from many investors. They employ a professional manager to invest that money in stocks, bonds, or other assets. There are places like Mass Mutual, I think Vanguard, Charles Schwab, I think all those type of places offer this. But basically, you are going to have this money managed by somebody else, and they're going to buy into a ton of different stuff. So mutual funds follow a set strategy. A fund might invest in a specific type of stock or bond, like international stocks or government bonds. Some funds invest in both stocks and bonds. How risky the mutual fund is will depend on the investments within the fund. So this is something that oftentimes, if you sign up for a 401k through your employer and they're going to do mutual funds, they'll send you a thing saying, what type of mutual fund, do you want more risk, more reward, less risk, less reward? How do you want to invest this? And a lot of them will have like a general checkbox, like more risk, more reward, and things like that. So I know Mass Mutual does it that way. That's something to keep in mind. But how do investors make money off mutual funds? Well, when a mutual fund earns money, for example, through a stock dividend or bond interest, it distributes a proportion of that to investors. When investments in the fund go up in value, the value of the fund increases as well, which means you could sell it for a profit. Note, you will pay an annual fee called an expense ratio to invest in a mutual fund. So this does have fees attached to it because, again, generally speaking, anytime your money is managed by somebody else and they're investing for you in certain things, you're going to pay a fee for that. Mutual funds are great because it's just companies buy into, they use your money, they buy into big portions of a specific mutual fund they have set up, which could be stocks, bonds, both, whatever it may be. And then you get paid out, like we talked about earlier, when there's dividends quarterly or, the biannual bond interest, whatever it may be, you'll get paid out a percentage on those as well. And then also your fund will grow over time, which is why 401ks grow and those sorts of things when they're invested in mutual funds. This one, typically, you don't have quite as much individual control over. It's kind of one of those things that normally comes with like your company or 401k or something like that, where another institution already has their funds set up and you kind of pick one to roll with. Next, you have the index funds, which basically an index fund is you are investing in an index like the S&P 500. It'll mirror the performance of the S&P 500. Like, for example, if you bought into Vanguard has an S&P 500 index fund that's really popular. I do believe a lot of these require minimums to get in, like $1,000, $3,000, those sorts of things just to buy in. So it can be a little bit pricey, but you do typically get good returns. Vanguard has a really good return rate over the last 30 years or something, maybe longer. Where I think it's like 10 to 15%, somewhere in there, which is a great return. But basically, index funds will follow an index. They kind of mirror it. So like, for example, if you bought an S&P 500 index fund, it will aim to mirror the performance of the S&P 500 by holding stocks of the companies within that index. So only buy into stocks within that index to kind of mirror the growth of the S&P 500. The benefit of index funds is that they tend to cost less because they don't have an active manager on the payroll. The risk associated with an index fund will depend on the investments within the fund. So although they are not held by an active manager, a lot of times you do have to have a decent minimum amount to get started in index funds, but that'll vary. Do your research, check it out if this is something you're interested in. How do you make money on index funds? Index funds may earn dividends or interest just like everything else, which is distributed to investors. These funds may also go up in value when the benchmark indexes they track go up in value. Investors can then sell their share in the fund for a profit. Index funds also charge expense ratios, but also noted above, these costs tend to be lower than mutual fund fees. So something to keep in mind. Most of these all cost money in some way, shape, or form to do them, but risk and reward changes on all of them, and how much you can get back changes on all of them. So index funds are kind of one of those things where you invest in it and you just leave it alone and never touch it again. Like, you just kind of invest in it and that's it. And then you'll worry about it later on down the road when you're looking at retirement. You'll maybe want to sell these off and get, how much the S&P 500 has gone up since you bought in, that sort of thing. And you can make a ton of profit that way. But if you're somebody who doesn't want to have to actively manage things, index funds are a great way to go. Then we have the ETFs, which is what I talked about earlier, the exchange traded funds. They are a type of index funds. They track a benchmark index and aim to mirror that index's performance. Like index funds, they tend to be cheaper than mutual funds because they are not actively managed. The major difference between index funds and ETFs is how ETFs are purchased. They trade in exchange like a stock, which means you can buy and sell ETFs through the day, and an ETF's price will fluctuate throughout the day. Mutual funds and index funds, on the other hand, are priced at the end of each trading day. That price will be the same no matter what time you buy or sell. So ETFs trade just like stocks. They'll go up and down intraday. So throughout the day, they'll be going up and down. And so that allows a little bit more flexibility when you want to buy in, as opposed to mutual funds and index funds, which are priced at the end of each trading day, and no matter what you pay, it's going to be the same, but they're priced at the end of each trading day. I have ETFs because I think when I bought Vanguard ETFs, they were like $115 a share right when COVID hit. And then now I think they've kind of bounced back up into like the 140s, 150s. So that's something to keep in mind, is that you have a little bit more flexibility on buying those. And you can buy those through like a Roth IRA through Vanguard. That's how I did it, where I purchased Vanguard ETFs through a Vanguard Roth IRA account. The bottom line is the difference doesn't matter to many investors, but if you want more control over the price of the fund, you may want to roll with an ETF. Oh, you don't like that one? Okay, well, I guess Oliver's not a big fan of the ETFs. I'm not sure what that's all about, but how do you make money? So as with a mutual fund and an index fund, your hope as an investor is that the fund will increase in value and you will be able to sell it for a profit. ETFs may also pay out dividends and interest to investors. So I know that the Vanguard ETF that I purchased does pay out dividends and has grown in value since I purchased it. So a lot of this stuff, if you really do your research throughout the COVID-19, now is not exactly the worst time to buy in, generally speaking, because a lot of prices have dropped down. But again, you want to contact a professional, do your research. That's just my opinion. But prices, in theory, will only start to go back up over the next 6 months to a year to 2 years, whatever it may be. But definitely plan on probably holding a lot of these options for a while. So a lot of the things that we're looking at are not quick overnight get rich quick schemes. There aren't those. If you want to do that, join a multi-level marketing company and then let me know how that goes. But then you have options. This is probably the one I'm least familiar with because they are the most complex in my opinion. But basically an option is a contract to buy or sell a stock at a set price by a set date. Options offer flexibility as the contract doesn't actually obligate you to buy or sell the stock. As the name implies, doing so is an option. Most options contracts are for 100 shares of a stock. So typically that means you're going to have more money up front to invest in options. But when you buy an option, you're buying the contract, not the stock itself. You can then either buy or sell the stock at the agreed upon price within the agreed upon time, sell the options contract to another investor, or let the contract expire. So if that sounds complex to you, it's because it is complex and requires an immense amount of research to know what you're doing when it comes to options trading. How do you make money on options? Options can be quite complex, but at the basic level, you're locking in at a price of a stock you expect to increase in value. If your crystal ball is right, you benefit by purchasing the stock for less than the going rate. If it is wrong, you can forego the purchase and you're only out the cost of the contract itself. So a lot more flexibility with these guys, but it does offer a lot more complexity with that flexibility. I threw it in here because it is an option, no pun intended, but it is an option for investing. If you're going to go this route, I highly suggest, any of these routes, you should talk with a professional. But when it comes to options, you really, really want to do your research to know what you're getting into. Stocks and options are the most volatile and probably the biggest risk in everything we looked at, but they also can have the biggest reward. So if one of those people who likes to gamble a bit, it's time to look. But that's where you can get into things like ETFs and things that are a little bit more solidified, where it diversifies your account for you. And you don't have to worry quite as much when things start to crash, because more often than not, it will bounce back. But yeah, so all that being said, I know that took like 45 minutes just to go through those. So it took me forever to put all this information together. Again, if you really like the information, if this is helpful in opening your eyes to stocks and trading and options and all that sort of stuff, please make sure to like, follow, subscribe, comment, whatever you got to do, and let us know what you thought about this, anything I can improve upon, those sorts of things. But finally, let's look at some brokers that are available to you. I use TD Ameritrade, which primarily is because they have the Thinkorswim platform, which is free. It's a great platform that can get you started in trading stocks if you're interested in day trading or buying your own stocks, that sort of thing. Thinkorswim is fantastic. It can do very basic scans and those sorts of things. But it's really cool. You'll learn a lot using Thinkorswim. They have a lot of educational features, those sorts of things, and is my favorite, definitely, by far, in terms of like if I'm doing day trading, I like Thinkorswim because I can see everything going on. A lot of the videos you'll see of other day traders or brokers, things like that, they'll have videos with Thinkorswim on there. Vanguard is also very popular. Again, you can set up the Roth IRA through them. That's what I have. You can trade through Vanguard accounts, and they have a lot of flexibility there, and they're very trusted and been around a long time. Then you have Charles Schwab, who also offers a lot of flexibility. They've been around for a long time. Fidelity, E-Trade, First Trade, Merrill Edge, which is, I believe, the offset of, it's like Merrill Lynch's version of that, so Merrill Edge. And then you have Ally Invest. These are just a few brokers that you can kind of look into if you're thinking about Roth IRAs, stocks, opening any of these accounts. You can definitely check into these brokers here to kind of get you started. But again, always do your research, check everything out first, make sure you know what you're getting yourself into before you spend any money or sign up for anything. The last thing that you want to do is sign up for something that you didn't fully inform yourself about and then end up having to pay monthly fees or having some sort of weird balance that you didn't know you had to have in order to qualify for savings or for interest or anything like that. So always do your best to be informed, get a professional if needed, and go that route. But I hope this information was useful. Again, I had a lot of people asking me where to even get started. When it comes to investing, there's so much that you can do, and there's so many different avenues depending on what your objective is, what the goals for, if you want it done in a year, if you want it done 5 years, 10 years, 20 years down the road, and obviously how much money you have. Real estate was something that I was planning on diving into and probably will be diving into further on. It's something that I'm relatively new to, so I want to make sure I've got everything lined up correctly for that video. But also, real estate investing usually requires quite a bit of money to get started. Just in terms of if you're going to buy rental properties or anything like that, usually it's a 20% down payment. So you need quite a bit of capital to get that going. But yeah, of course, if you guys have anything that I missed, if there are some things you think I maybe said incorrectly, or if there's some other things that were very clearly missed that I should have mentioned in the podcast, leave it in the comments below. Let me know what you like, what you didn't like, some other things like that, and let me know what you're doing to set up for the future, and so that you can be fine if another pandemic or an economic collapse happens. You will be like the Rothschild, just living the dream and not worrying about absolutely anything. Because that's what we all want at the end of the day. Or if you're like me and you ever plan on having kids and you want to make sure that you aren't constantly struggling to try and make ends meet, getting things like that started now is the best first step. Nothing in here is going to make you millions of dollars overnight, or 5 years from now you're going to have millions of dollars in the bank. I mean, I guess technically speaking you could, but that depends on what your financial situation is currently. General rule of thumb is you kind of got to have money to make money. And the other one that I just keep repeating that I can't get enough of is that more risk equals more reward. Usually and generally speaking, the lower the risk, the lower the reward. So you'll see that a lot with investments in general. A lot of things that are kind of more volatile, like, I don't know, penny stocks or day trading or anything like that in general, usually has a lot more risk associated with it. But you can also get, a lot more bang for your buck if you know what you're doing and have a little bit of luck. So with all that being said, thank you guys so much for tuning in. I really appreciate it. Again, don't forget to check out the other videos if you want to see what I've been doing during the quarantine, how to stay productive, maybe some ideas there. Or if you want to see what my thoughts were on Texas reopening and going through this whole madhouse that is now, trying to figure out if we should be going out now. Do we listen to the governor? Do we listen to the mayor? Who knows? But yeah, make sure you guys like, follow, subscribe. I really appreciate that. It helps out quite a bit, and it gives me motivation to keep going. I obviously went maybe a little bit above and beyond on this one, creating that beautiful PowerPoint presentation for you. But I hope at the end of the day, at least somebody got something useful out of this, and you can get started in setting up, your future and some of the avenues that are available to you. And obviously everything I went over here, I tried to keep it to where it does not cost you a lot of money to get started on these things. So definitely let me know, especially if you set this up and come back to this video a couple of months from now. Let me know what you did and how it all turns out. So thanks everybody. Again, please don't forget to like so that we can destroy that YouTube algorithm, and subscribe so that I can feel validated as a person. And I will be back next week with episode 4. I don't know exactly what it will be on just yet, as most of the time I decide about 24 hours before I actually start the recording. So thanks again, everyone. Also, it might as well note that the iTunes and SoundCloud versions of this are going to be a bit different. I made a beautiful mistake of leaving up last week's banner image. So it said episode 2 to reopen it was like to open or not to reopen. That is the question. I had that up the whole time, so I had to re-record that. Otherwise, it just pissed me off. So I was like, I could just throw the banner across the whole thing and hope nobody notices, but it's kind of obvious. So figured I'd go ahead and re-record that so that it's at least a little bit more professional. But thanks again, everyone. Make sure to check us out on pretty much everything on social. Let me know what you think, and hope you guys have a great rest of your day. Stay healthy, stay safe, and I'm out.